Hello and welcome to Scientific Investor Series. In the last video, we discussed that sometimes your portfolio is not moving when the market is going up and you feel disheartened. And one cause that we discuss is over-diversification. Or maybe you can say that diversification without an intent or without a conviction, right? Now let's understand, what is the right way to diversify your portfolio. So there's no doubt that diversification is required to manage risk, right? We don't believe in, buying a 2-stock or 5-stock portfolio and trying to, do better than the market. That's highly risky. That is highly speculative. That is not what equity investing is all about, right? So equity investing starts with diversification, building a portfolio approach, right? Now you want to add multiple stocks from multiple sectors and diversify and build a portfolio which is robust, resilient, and outperforming, right? Now what we have seen that people end up buying stocks from across sectors, top companies which are strong, large, stable companies in a pursuit to diversify across sectors and across market capitalization, right? But in a nutshell, what you end up doing is you keep replicating the market portfolio in your own way, right? And you have deviated from the market, like you missed out or you avoided few sectors which you didn't like or you didn't feel confident about, but you have deviated, yet you have tried to kind of replicate the full market, and that's not a strategy. That is a strategy to kind of remain continuously behind, right? So you're doing extra effort, trying to build a portfolio to outperform the market, but you are worse off practically than the market returns. So that's the problem where diversification, over-diversification without really understanding how you should diversify. That's the problem, right? Now at Omniscience Capital, what we believe in diversifying across multiple growth vectors, right? So going back to the basic rule of investing is that how should you look at stocks or look at portfolio which can potentially give you returns, high returns, right? Whether it is ahead of the market or not, that's another thing. But on an absolute basis, you want to invest in companies or sectors which give you a good yield. Okay, that's the first component of your return, that can grow faster than the broader economy, right? So higher growth, that's a second requirement to be ahead of the market. And the third is that you have to buy it at a reasonable price or a discount, right? Because if you have overpaid for a high growth company, even then you are going to be behind the market, right? So once you put these three things together and say that you are getting a company or a set of stocks from a particular industry or a sector that are available at a good yield, the growth outlook for the next 5-year, 10-year is stronger than the broader economy, and then you are able to find them at a discount as well, right? So if all these things are there, then obviously this portfolio is going to outperform the broader market, right? Over the full cycle, let's say over a 5-year period, this is what the expectation is. Now, once you do that, you build a portfolio diversification by putting multiple growth vectors, right? They could be from different sectors, different industries, and so on. But once you do that, that is the real diversification that you are trying to do, right? So here you are replicating, rather you are deviating from the broader market portfolio. What you have done here is that you have deviated from the market, but you have built diversification by taking exposure to multiple growth vectors, right? So it is high conviction, you understand what you are doing, and you can remain invested for a longer period, no matter your portfolio is outperforming in the near term or not, right? So that is something extremely important. Now, the other question that people have typically when it comes to diversification is that should I buy, like I like a particular stock, sector, okay, let's say banking or financial services or whatever, and then you'll say that okay, there is no point in diversifying across a particular sector. Yeah? Just go after the best, the leader, the best company, the best managed, well-run company, and that's it, right? Now, because the sector might be a high growth sector, it might be expected to grow faster than the broader economy, but the best company may not be mispriced, right? So that's why you need to diversify even in a particular growth factor, even in a particular sector or industries, and look at multiple companies, right? So it's the idea is not to buy the best company in a particular sector. Idea is to buy all the companies in that particular sector which you have identified, which is particular growth factor that I just talked about, that you want to buy all such companies which are available at a significant discount, right? Now this is the next level of diversification, going beyond multiple sectors or multiple growth factors, that inside a particular growth factor you are buying different 5, 7, maybe more companies which are all available at a discount to intrinsic value. Now what happens in that case, that you have reduced your company specific risk, right? So because anything unexpected can happen in a particular company, but if you had gone only with the leader or the largest of that particular sector, then you were still running the company specific risk, right? But if I have 5 companies from that high growth, a sector or a growth factor, then I have reduced the company specific risk, yet I am exposed to all the growth that is to come for that particular sector, right? So that's the second level of diversification, and that is what we call an optimal diversification that the investor should look at.